So what is cap rate? Why is it important? And how can you use it in your rental property investing to help you buy future investments and analyze your current portfolio?
Welcome back to our 5-part series. Today we're going to be talking about cap rate and why it's important when you're looking at investing in a property. So Colin, what is cap rate?
So cap rate, what it is it's a metric that analyzes, or a ratio or a percentage that analyzes the stream of income that a property produces. And it doesn't take into account your mortgage or debt. Put simply, it's your net operating income divided by your basis, which is also like the price that you paid for the property or the asset's value.
Exactly. So if you were to invest 100% cash or something, what kind of return could you expect for it in year one?
Exactly. So today we're going to break down one of my properties, the cap rate on it. We're going to use it as an example to show how you calculate cap rate.
So jump into what your property is.
Yeah. So I own a condo. It's in Lehi, Utah. We bought it. We actually live in it. We're living in it now. We'll live in it for a year. We'll eventually move out. That's a strategy that we'll talk about later. We're going to run these numbers as if I would have bought this as an investment property just up front.
Yep.
Just because I think that's what anybody should do, even if they're running a different strategy to invest in real estate.
So what are your current income from the property?
Yeah, so just running, basic analysis. So I know we could rent this property for about $1,500 a month.
Cool. And what are your expenses?
And when we run expenses, keep in mind, I'm very conservative in my numbers. So we're budgeting for the water heater that we're doing every 8 years. We're budgeting for the HVAC that we're doing every 10 years, painting, carpet, all these things that could come up, we budget for it. And after running all that, we get an expense of about $640 a month. And so that gives me a net operating income monthly of $860 a month. And when you times that by 12, that gives you an annual net operating income of $10,320.
Awesome. So that is your net operating income. What's next when it comes to calculating cap rate?
So the next we need our basis. So the basis is going to be what I paid for the property. And when we bought the property, we paid $261,900. And then all you have to do that's left is you just simply divide the two, right? So after you take $10,320, you divide that by $261,900, you're going to get a cap rate of 3.94%. And so that would be my unleveraged rate of return for my income stream. So if I had no debt on the property and you were just analyzing how much income this is producing, we're not talking about the value of it going up, we're not talking about depreciation or other things, just that income stream, it's a 3.94%.
And this is looked at a lot in commercial real estate investing, not as much in residential, but it's important. It's a great screener when you're looking at properties to invest in to just say, what is the cap rate?
Absolutely. And the reason people use it in commercial is it's popular in commercial real estate to have what's called a triple net lease. And what a triple net lease is basically like, say I own a gas station. The person who is my tenant that I'm renting that gas station out to takes care of everything. They're going to take care of all your expenses. They're going to take care of, any expense that could come up, they're going to take care of it. And so that's why it's so important that in commercial real estate, because they're not factoring in, the water heater, because the tenant would take care of those things.
Yeah. So where does it come in then in residential?
So in residential real estate, people use it just as more of like I would say almost like a market snapshot, right? So like different areas are going to have different cap rates, and you can find one-off properties that have different a higher cap rate or a lesser cap rate.
Yeah.
And just for example, you can find a good deal. But I'd say more commonly than not, it's like, for me, I just use it as like, hey, this is what the cap rate is. Let's now look deeper into the property. Let's look into other analysis to find out what my actual rate of return would be. Just so you can like weigh out, if it's a really bad cap rate, it's not a good cap rate for that market, you can just kind of throw those properties out.
Yeah. So again, it's just an initial screener for you to look and see, okay, is this property worth diving in deeper?
Sure. And to talk more about that, like commercial real estate and how it's used, commercial real estate is actually priced off of a cap rate. Because people buy commercial real estate, they're buying it for the purpose of this income stream. So a lot of times you'll see a higher cap rate for commercial real estate and a lower cap rate for residential real estate. A lot of times the reason for that is because people aren't buying residential real estate for this income stream, right? They're buying it to live in it. And so it's going to be priced off of what other people will pay for it and are willing to sell it for. And so commercial real estate, all priced off of cap rate. Residential, priced off of what a willing buyer and a willing seller are willing to pay for.
Exactly. And that's why we don't just base off our investment decision off of this number. We're going to look at other numbers as well. We'll talk about them in our next videos.
Absolutely. Thanks for tuning in.